What if you could consistently buy something worth $1 for just, say, 50 cents?
Sounds almost too good to be true, right?
Yeah.
Like some kind of financial alchemy.
Exactly. But this idea, it isn't a fantasy. It's actually the core of value investing.
And it's less about magic and much more about a really considered method.
Today, we're doing a deep dive into this whole world. We want to unpack the fundamental idea of value investing, and we'll do it mainly through the lens of Benjamin Graham.
Often called the father of value investing.
Yeah.
His books, The Intelligent Investor and Security Analysis, they're foundational.
Absolutely. And to, add another layer, we'll bring in some observations from John C. Bogle's Common Sense on Mutual Funds.
Good call. Bogle adds a really important perspective, especially on costs and long-term strategy.
So our mission today, we want to cut through all that market noise, the fads that come and go, and reveal those timeless principles that can help you become a more intelligent, more disciplined investor.
It's really about spotting genuine value, isn't it? Not just chasing what's popular.
Precisely. So let's get started.
Okay.
All right, let's unpack Graham's #1 insight. It seems obvious maybe, but it's so easy to forget. A stock isn't just a ticker symbol.
Right. It's not just a blip on a screen.
For people navigating the markets, why is understanding that so critical?
Well, it's simple, but it changes everything. Graham's core idea is that a stock is an actual ownership interest in a real business.
Ownership, like you actually own a piece of the factory, the brand, everything.
Exactly. And its real worth, what he called its intrinsic value,
Right.
that exists completely separate from whatever the stock price is doing day to day. Getting that difference is, well, it's fundamental. It's what separates real investing from just, speculating.
So you're buying part of a company, not just a number that bounces around.
Precisely. A company that makes things, sells services, earns actual profits.
Yeah.
When you truly internalize that, your focus shifts. It has to.
That perspective makes a lot of sense, but I imagine it's incredibly hard to hold on to when the market's going crazy.
Oh, absolutely. It takes real discipline.
How does an investor make that actionable? Especially when, everyone else seems to be running for the exits or piling in.
Well, if you see it as owning a piece of a business, you naturally start looking at the business's health.
Like its balance sheet, earnings.
Yeah, exactly. Its earnings power, its debts. Does it have a competitive edge? You're not just looking at the stock price chart.
So it frees you up a bit from reacting to every little news flash.
It does. It forces you, or helps you, think like a long-term business owner. Is this enterprise stable? Can it grow? Not just, will the stock go up tomorrow?
Okay, that leads perfectly into this next idea, Mr. Market. This is where I think a lot of people get tripped up. Graham uses this character, this metaphor.
It's a brilliant metaphor.
Who is Mr. Market? And what's the maybe less obvious way to handle his dramatic personality?
So imagine Mr. Market is your business partner, but he's, let's say, a bit emotionally unstable. Manic depressive, maybe.
Okay, sounds familiar in market terms.
Right. Every single day, he shows up. No fail. And he offers to either buy your share of the business or sell you his share.
And the price changes every day.
Every day, a new price. Sometimes he's incredibly optimistic, just bubbling with excitement, and he quotes you a really high price. Sees nothing but blue skies ahead.
10 other times.
Other times, he's completely despairing, totally pessimistic, convinced everything's falling apart, and he'll offer you his shares or buy yours at a ridiculously low price.
So dealing with Mr. Market sounds like a challenge. What's the biggest mistake investors make with him?
The biggest mistake is listening to him as if he knows the real value, letting his mood swings dictate your actions.
Taking financial advice from the manic depressive partner.
Exactly. The intelligent investor, Graham says, is the realist. You use Mr. Market, you don't follow him.
Use him how?
You take advantage of his emotions. When he's euphoric and offering crazy high prices, way above the business's real worth, maybe that's a time to consider selling to him.
And when he's terrified.
When he's panicking and offering rock-bottom prices far below what the business is actually worth, that's your opportunity to buy from him.
So the quotes are just offers?
They're there for your convenience. That's the key. You can act on them, or you can completely ignore them. Never buy just because the price went up. Never sell just because it went down.
Be opportunistic, not reactive.
Precisely. Patience and opportunism, not emotion.
Okay, so if the market swings like that, driven by emotion, how do we actually find those dollars for 50-cent deals? What are we looking for?
Graham and Dodd, they were very direct about this. They said, look for securities at a hefty discount to what they are worth.
A hefty discount, not just slightly underpriced.
Right. This is the core of buying dollars for 50 cents.
Mhm.
You're looking for situations where the market price is significantly, maybe even shockingly, below the intrinsic value.
You're looking for that margin of safety.
Exactly, that buffer. It protects you if things go wrong. If your analysis isn't
Yeah.
perfect or if the economy turns down, it's your shield.
So we're not just looking for a stock that dipped a bit. We're looking for a fundamental mispricing.
That's the goal. A structural undervaluation.
Can you give some real-world examples from the sources, times when this actually happened?
Oh, definitely. The sources mentioned South Korean stocks at one point.
Hmm.
Some companies were selling for less than their tangible assets were worth. Imagine that.
Less than the value of their buildings and equipment.
Pretty much.
Yeah.
And investors who saw that made multiples on their money. Or think about the Great Atlantic and Pacific Tea Company, AMP, back in 1938.
The grocery chain.
Yeah. After a big stock decline, it was selling for less than the cash it had in the bank.
Wow. So you bought the cash and got the stores and inventory for free, essentially.
Effectively, yes. And another stark one, Studebaker Corporation in 1933. Its securities, all combined, sold for less than a third of its cash, just the cash, and only about 1/7 of its net current assets, cash, plus inventory minus short-term debts. The factories and everything else were basically valued at 0 or less.
Incredible. Do these things still happen?
They do, maybe less obviously sometimes. Think about entire sectors getting punished, like energy stocks back in 2001 when oil prices were super low. People just wanted out, regardless of the long-term value of the assets. Fear creates those deep value opportunities.
So that's the investing side. What about the other side? What did Graham call speculation? How is that different, especially chasing quick profits?
Graham drew a very sharp line there. He really pushed back against any kind of speculative formula that promised easy money fast.
Like trying to time the market based on seasons or jumping on hot trends.
Exactly. Things like the old January effect, or chasing momentum, or trading on news headlines. He was very blunt. Investing on the basis of projection is a fool's errand.
Don't try to predict the future.
Right, because you can't reliably. Instead, the intelligent investor focuses on protection.
Protection from what?
Protection from paying too much for a stock. And maybe just as importantly, protection from being overconfident in your own analysis, your own judgment.
So it's about rigorous analysis and staying grounded.
Yes, realism, not wishful thinking.
Okay, if we're not forecasting, what does this intelligent effort actually involve? What kind of analysis are we doing? Does it mean building super complex financial models?
No, actually the opposite. True value investing, for Graham, requires diligent analysis of the business itself.
Understanding how it actually makes money.
Exactly. Understanding its operations, digging into the financial statements, the real ones, not just the headline numbers. You have to distinguish genuine, sustainable earnings from accounting tricks or one-off gains.
Like companies trying to make their earnings look better than they are?
It happens. The sources mention a company, Manhattan Electrical Supply, back in 1926. They included profits from selling off major assets right into their regular operating income.
Making it look like the core business was more profitable than it was.
Precisely. An intelligent investor has to see through that kind of thing.
And what about the math? Do we need advanced calculus?
Definitely not, according to Graham. He specifically warned against using higher mathematics for stock valuation.
Why? Wouldn't more math be more precise?
He argued the opposite. He said, the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions. Basically, complexity often hides shaky assumptions.
So keep it simple.
Yes. Dependable calculations, he felt, should stick to simple arithmetic or the most elementary algebra. Focus on understanding the fundamentals clearly, not creating a fancy but potentially misleading formula.
Interesting. It sounds like he was really pushing back against some prevailing ideas of his day, too. What was this new era investment fallacy he talked about?
Ah, yes, the new era thinking. This popped up in the 1920s. But we see echoes of it in every market bubble, like the dot-com boom.
What was the core idea?
The theory was basically that for good companies, especially growth companies, the price you paid for the stock didn't really matter.
Price doesn't matter. How could that be?
The argument was that stocks would just keep going up because companies reinvested their earnings, constantly adding value. So any price was justified eventually. Graham thought this was incredibly absurd.
A radical fallacy, he called it.
Yes. Because if you ignore price, you're completely ignoring value. You're detaching yourself from the underlying business reality. It's the kind of thinking that inflates bubbles this belief that this time it's different and the old rules don't apply.
A timeless warning, it seems.
Absolutely. And speaking of protection, Graham focused on protection from overpaying, but John Bogle really highlights another critical area, protection from costs.
Costs, like fees and expenses.
Exactly. Even if you find a great company at a decent price, Bogle points out that management interests don't always align perfectly with shareholders. Think about things like stock buybacks done in ways that might benefit insiders more.
Hmm.
But the bigger, more constant drain Bogle emphasizes is what he calls the tyranny of compounding, applied to costs.
The opposite of compounding returns.
Precisely. High expense ratios in funds, frequent trading commissions, taxes.
Okay.
They silently eat away at your returns year after year. Even if you bought that dollar for 50 cents, high costs can shrink it back down significantly over time.
How much impact do costs really have?
Well, the sources suggest the typical actively managed fund needs to beat the overall market by something like 3.5 percentage points before costs, just to match the market return after costs.
Wow, that's a huge hurdle.
It is. It underscores why Bogle champions simplicity and low costs. It's a direct extension of Graham's whole philosophy of protection and focusing on what you can actually control.
Okay, so pulling this all together. Graham's focus on value, Bogle's emphasis on costs. What does this mean for our strategy as individual investors?
Well, both of them, Graham and Bogle, they really hammer home the importance of time and patience.
Letting time do the work.
In a way, yes. Graham's idea of reversion to the mean is key here.
Meaning prices eventually come back to reality.
That's the idea. Market prices can be wildly emotional in the short term, we know that. But over the long run, they tend to gravitate back towards the real underlying value of the business.
So patience isn't just about waiting, it's part of the analysis.
You can say that. It allows you to buy when Mr. Market is depressed, sell when he's euphoric, and then just wait. Let the market cycles play out. Don't get caught trying to predict the next wiggle.
And Bogle's point about performance chasing fits here too, right? Past winners don't always stay winners.
Exactly. There's no reliable proof that a fund manager who did well last year will do well next year. Often, top performers revert to the average or even below it. As Bogle liked to say, the secret is there is no secret.
Keep it simple.
Keep it simple, keep costs low, be patient.
What about diversification then? Graham seemed to focus on analyzing individual companies deeply. Does that mean we shouldn't diversify?
Good question. While a master analyst like Warren Buffett, who clearly learned from Graham, might successfully concentrate his investments.
That's probably not wise for most of us.
Right. For the vast majority of investors, Bogle would argue, and I think Graham would agree for non-professionals, not diversifying is foolish. It's just too hard to consistently pick only winners and avoid the losers.
So diversification is still key for managing risk.
Absolutely. And this is where Bogle's advocacy for index funds comes in so strongly. A low-cost, total stock market index fund.
It basically lets you own a tiny piece of almost every company.
Exactly. Every stock worth owning, essentially. You capture the market's overall return, you manage risk through broad diversification, and you do it with minimal cost. It aligns perfectly with Graham's prudence and long-term view. You benefit from that eventual reversion to the mean without needing to be a stock-picking genius. And that simplicity advantage, you really can't overstate it. Bogle's line, "The secret of investing is, finally, that there is no secret," just nails it. These straightforward, low-cost strategies, like indexing, they've consistently done better than most complex, high-turnover, actively managed funds over the long haul.
It fits with Graham preferring simple math, too.
It does. Focus on fundamentals, control your costs, avoid chasing performance or fancy new products the industry pushes. You know, the index fund was initially mocked, called Bogle's folly,
Hard to believe now.
isn't it? Now it's seen as a cornerstone of sensible, intelligent investing. It's definitely here to stay.
So to wrap up our deep dive today, we've seen how value investing through the wisdom of Graham and reinforced by Bogle really pushes you to think like a business owner, not a gambler.
Right. Use Mr. Market's moods. Don't be swayed by them.
And prioritize that diligent analysis, but also be incredibly focused on keeping costs down. Find real value, don't chase hype.
It's about cultivating discipline, perspective, knowing the market can be irrational short-term, but trusting that fundamental value and the power of compounding usually win out long-term.
So here's a final thought for you to consider. In this world just overflowing with information, data, and quick fix investment schemes, if you really could buy a dollar for 50 cents consistently, how much genuine effort would you put into truly understanding what that dollar is worth?
And just as importantly, how much patience would you exercise to wait for that right moment, that 50-cent opportunity?
Your answer to that, it might just shape your entire investment journey.